What is up, and welcome back, everyone, to another episode of the Long Game Podcast. Today, we're switching it up. So I have a guest, and Nate's here. We're going to talk about him in a second. But for everybody listening, you know that for the last 6 months, I've done only solo episodes, changing the podcast that way to kind of basically knock out two birds with one stone between YouTube and the podcast. But I realized I like it way better having guests on. And so I'm going to start having guests every other week. And I didn't think there was any better place to start with than with Nate Sosa. So Nate's a CPA at Hall CPA. They basically specialize in real estate, but he's kind of one of the go-to resources here on this new tax bill. And, I think that this new tax bill is something that we have to talk about. I see on Twitter all the time, people say, don't talk about it. It's not enforced yet. But I actually can't even tell you how many times clients have already brought up this tax bill. I had an email just yesterday from somebody that was like, how bad is this going to be for me? And it's an important question. I tell everybody we're not making any tax changes this year until we know the tax bill. We're not moving entity elections. We're not worrying about PTEC going away. We're not thinking about SALT yet. But I still think it is helpful to educate people on where the tax bill is at, what is being said, how the planning would change, just to start to think about it ahead of time. So I basically went out to Twitter and said, hey, who wants to hop on and do the podcast? I had tons and tons of people reach out, and then I had a bunch of people say, you got to have Nate on. And so, Nate, really appreciate you joining us today.
No, thanks, Thomas. Thanks for having me on. It's like you mentioned, man, like everyone's clients, other CPAs, like regardless whether or not we're paying attention to it. Now, making sure we don't lock in that these are permanent provisions, right? Like we'll talk about here in a second, is that there could be modifications from here till the final passage. And making sure like we already had amendments from the Ways and Means draft to what's happening now, right? With the SALT cap increase. And so it's like being aware and understanding what's happening and knowing Congress's intent with all of these actions is super important, especially for our clients down the road when we start doing tax planning or things of that nature. It's really important. Like you said, clients pay attention too. So it makes us a little bit more, feel more trusted when we know what's going on in the legislation while making sure we don't lock it into our brain as that's the law.
Totally. Well, update us where the bill is at. We'll go into the key changes there, but I think it's helpful to just start I think people saw that it passed yesterday. And so their thought was, oh my gosh, this is in force. But update us kind of where it's at and in history, how much it changes after this kind of state.
Yeah, Thomas. So we kind of have a roadmap that we've already seen with this back in 2017, right? Because it's not the Tax Cuts and Jobs Act 2.0. It's the one big beautiful bill, but it essentially is the Tax Cuts and Jobs Act 2.0. And so right now it's gotten out of the House. The House passed it at 5 a.m. in the morning. So it's like they basically went from 1 a.m. I think Wednesday morning to 5 a.m. I
would not want to work for the government. Let me tell you what.
Yeah, it's terrible. And what's the worst part is all they're doing is talking about random legislative items they have to do. It's like, well, this order has to go into place, and then that order, it's ridiculous. If you ever watch it on C-SPAN, it's boring if you want to take a nap.
That's why I don't watch.
Yeah. And so basically, right, so it's passed the House. So that means now it's being kicked to the Senate. So it means the Senate has to go, the Senate has their own committee, just like the House did, and they're going to mark it up. And actually, if you look back in 2017, the bill that came out of the House Representatives was not the same bill that went to the president's desk. So there's going to be a lot of change that happens in the next 4 to 6 weeks with the Senate. So a lot's going to happen. And Mike Crapo, he is the Senate Finance Committee leader. He's already said, yeah, we're going to make changes. Things are going to be different. For example, qualified opportunity zones, those were barely in the bill in the initial 2017 Tax Cuts and Jobs Act. And that's going to be massively changed, in my opinion, in the Senate as well. And we'll see what else happens. One thing the Senate has actually identified and said they would love to change if they can score it properly is making 100% bonus depreciation permanent. So that's one item they really would like to have permanent. Economic, like business owners would love that, and economists love it too. So it could really be helpful. So we have to go to the Senate, and then once it goes out of the Senate, which is the next 4 to 6 weeks, then gets kicked back to the House, where we might have to do the entire situation again if there's a bunch of changes, right? Ways and Means Committee leader Jason Smith said he doesn't think the Senate's going to make a lot of changes, but I think he's kind of wrong.
Yeah. And I think the interesting thing about it too is what this timeline is going to be, because there's a bunch of changes. It goes back, and then they make changes and it passes, and then it goes back. Like, some of the parts of this bill are retroactive to January of this year, and other parts are not. And I think this is where all the tax planners of the world complain, because you're like, how are we supposed to plan for a tax year when we're already 5 months in and a new bill hasn't been passed with retroactive parts? And then all of a sudden it's going to get passed. I think their goal is the end of summer. Let's be real. That's best case scenario. It might be like November. And then all of a sudden you're thinking about, bonus depreciation and some of those changes that would be retroactive to January, which is just not an easy way to plan.
No, it forces us to do dual calculations, right, Thomas? And so, like, basically, have to like say, all right, this is we have to we got to play by the current rules, but also with the anticipation that they're slightly going to change. I expect 100% bonus to come back. If anything, that one's get even we get a watered down bill, we're gonna get that back at some point in time. But it's like then figuring out what are the other provisions that are going to wind up getting modified.
Yeah. Okay. Well, I think we should now transition into the different parts of the bill. And, I think from a lot of the content I see from everybody else, they're really just saying what is in there. And then they're not talking about what this means. And so I think the goal for me is that you go, you bring up one, and then we just talk about it. And then we go to the next one, and then we talk about it. And then if there's any ones that I feel like bringing up, I'll kind of put those in as well. And maybe if you do have a stance on, oh, this really doesn't seem like that's going to end up being part of it, obviously you don't know, but you can take some guesses there on, hey, I think that this is kind of a one that won't make it through.
Great point. So one item, so bonus depreciation, right? That's coming back. That's the one I feel 99% confidence going to return. It's right now going from 2025 through 2029. So it's going to be 5 years, 100% bonus depreciation. Super favorable, better than what we had in 2017. The only issue right now, and this could be changed, is it goes from 100% in 2029 to 0%. So that's the only difference. We don't get the sliding scale that we had in the prior year. So we'll see that could get modified. The Senate could change that up. Like I said, they want to make it permanent, so that would definitely be a big change if they made it permanent. Yeah, but I feel like bonus depreciation is definitely a lock, and I don't think there's going to be any changes there. Yeah. And then I think QBI is another.
Let's talk about that one a little bit more. Let's talk about the bonus depreciation one, because I think that one's really, really impactful. I think if you're a business owner or anybody in real estate, you understand this. Other people, maybe not so much. But again, I work mostly with business owners. And so this does make a big change, right? This makes buying a building for your business that much more attractive, right? I think one thing people don't think enough about, right, is real estate's passive. But if you buy a building you operate in, those losses can actually offset business income. And so it creates this really great opportunity, it might push more people to buy vehicles at the end of the year and do things you shouldn't do. And so when I think about bonus depreciation, I'm like, great tool if you're buying real estate for your business, great tool if you're a real estate investor, great tool if you're a real estate professional, great tool if you're buying things for your business that can be depreciated. Terrible tax tool if you buy things that you don't need, which, it just as well as I do. A lot of people only think through the lens of taxes, not aware that even with bonus depreciation, you're still spending money and, you're not coming out ahead.
Some people don't think through that often enough. Is it like, okay, I'm just like, if it's a need for the business, like you mentioned, like, great, you need to buy a new fleet of trucks, right? You need 3 new trucks that are actually going to be used by your employees. That totally makes sense. Yeah. You're like, I want to get a new Raptor, right? That's a new Ford Raptor. I get it, but do you need it? Is it improving the business? And sure, if you've got the funds and you're going to drive it for business, then fine.
And if you were going to buy it anyways, it's amazing. If you weren't going to buy it anyways, not so much.
Right. Exactly.
Okay. Next one.
Yeah. So QBI, right? So qualified business income deductions is a massive planning tool that we got back in 2017. It was set to expire this year. So it was like we were all kind of on the fence. It's like, man, are we going to get our business owners going to continue optimizing this? Because if it sunsetted and it disappeared after 2025, then all of a sudden C Corps become way more attractive, actually, right? Passive entities become less attractive just because there's a low C Corp tax rate. But we actually got, oddly enough, we thought we might get a C Corp rate drop. We didn't get that. Instead, we got a QBI increase. So it went from 20% to 23% for qualified business income owners. Now, it sounds really easy on its face until you look under the details, and then you realize that there's a lot of actual calculations for high-income earners that once you get to certain thresholds, you're no longer just getting that flat 23%. You actually have to do a bunch of massive calculations, figure out optimizing wages, whether it's unadjusted basis of assets that you own in your business, right? There's a lot of complex stuff that goes there, but this is a good increase for business owners. It's going to be helpful for tax planning even. And actually, SSTBs, specified service trades or businesses, which would be accountants,
Me,
financial planners, right? Us,
consultants, there's a
lawyers,
lot of
doctors, right?
consultants.
Yeah, they actually, there's a modification to it that allows them to actually get a bigger benefit than they would have had in the past. They actually will get to,
Really?
they will get to. Yeah, so there's a two-step, so there's the original calculation that we have where you look at the phase outs, the changes, et cetera. And then there's a second test that goes, it's an or, it says, or if that's zero, which it would be for anyone that makes up, let's say $600,000, right? Let's say $600,000, you're probably not getting in QBI if you're an attorney or a doctor. In this new calculation, there's basically, it's like, I hate saying it out loud because it's really complex, but basically you look at what you are over the threshold limit to get what you normally get phased in. So let's just say you have a $700,000 business and your taxable income is $480,000, right? So now you basically take that difference less that times like 75%, and that winds up being your QBI deduction. So actually I was doing some of the Excel math. Those who have taxable income of like $555,000 that own SSTBs and operate SSTBs will actually, that's the sweet spot for their deduction at the end of the day. I think the answer is like $180,000, something like that. But there actually is a chance, like SSTBs are able to claim the deduction easier now than they used to be able to.
So before it was, under 483, you just get 20%. Now under 483 or whatever the new number will be based on inflation, you'll get 23. Well, I guess there's that phase out part for like 100K. Right. So let's just move out of there, just below. And then above, non-SSTB is still going to be lesser, 50% of wages or 23% of profits. But then for an SSTB, if you make like $1 million or $1.5 million or $2 million, is it going to be $0 still?
If you're an SSTB, yes. Now it's like, it comes down to your taxable income, which is going to be like, that's like, it really comes down to your SSTB and then looking at what your ultimate taxable income is with the calculation. It's not as easy, but there's a way that you use real estate or something like that, and it's
Cash
not
balance
QBI
plans.
income, right?
Wow.
And so you might be able to modify it. It's going to be very niche situations, but it basically did open the door a little bit, in my opinion, for SSTBs to take advantage of that.
Well, I mean, it makes a lot of sense, right? Because before, if you were an SSTB making $500-600, bonus depreciation, cash balance plans, profit sharing 401ks, like those are really impactful because you can get the deduction there, drop to be inside of that 20% deduction, and then also pick up QBI when you'd have zero. So there's some really great tax planning that could be like, oh, great. Maybe I brought my taxable income down 150K through other ways. And so that saved me, let's say, $40,000 on tax, but then I picked up 20% QBID on another $400,000. So I basically saved, $50,000 to $100,000 in tax because I got it low enough. Now it'll be really interesting to figure out those numbers, to figure out for these high income SSTBs, how much more impactful are, these added deductions through bonus depreciation, spouse, real estate professional, cash balance plan, 401k and profit share, all of that stuff to get you into a level to get any QBID.
Yeah, definitely. Yeah, there's like more opportunity than there has been. So I totally agree with you.
Well, that sounds great. At the end of the day, QBID was complex. Like, I feel like I'm one of the few who like really talks about it and creates good visuals on it. Cause I find like every client who comes into me is in no way maximizing it. And you're going to get the, CPAs in the world who are like, oh, you can't just edit salaries to max out QBID. And maybe, I don't know, I work with a bunch of CPAs who were IRS regulators. And from their stance, they've always said, I've never seen anybody get mad because you pay more wages. If you end up going from 200 to 400 in wages and that maxes out QBID and it's a pretty good percentage of your profit, the IRS isn't really going to get mad that you're well above the Social Security wage base. You're paying all of yours. And a lot of CPAs take the stance that if you're a high earner, as long as you're above the Social Security wage base, we're fine with that.
Yeah, totally. Yeah. The reason that is there's nothing for the IRS to come after, right? And so actually for those who are S corporations, like you're saying, is like, if you got a higher wage limit, that's great because now you've got a higher reasonable compensation versus having a little too low of a reasonable compensation that so many folks with S corps wind up dealing with. So yeah. I agree with you in that perspective. That definitely makes sense. Like, it helps them with deductions. The only thing I think about is if granted, I've never seen a QBI audit personally, and there's zero tax court cases on QBI. So it's not a whole, so there's not a whole lot to go off of. Having something in your records to just document that basically, hey, this is the calculation we got to, this is why, etc., to kind of explain it away is the only thing that that I'd consider. But
I'm sure the issue comes more on the low wages. Hey, you're a salary heavy business as an S corp, and that's why sometimes a partnership would be better in those type of businesses. But let's say you are an S corp, right? Like the issue is if you $50,000 would be maxing out QBID, but really you should be paying yourself at least 184 because of profits. That's the one where, you can optimize with higher wages pretty easily. Lower wages, I mean, that's going to be one that you're going to lose on pretty easily. I mean, you can't make $700K and pay yourself a $50,000 salary. It's just not going to work. Okay, next one.
Yeah, so we'll go to SALT because there's really two ways we can hit SALT here, right? So the SALT cap for individuals is raised. So now instead of being stuck at $10,000, which was painful for anyone in a high income state, now that cap's raised to $40,000. And so now that means you can deduct up to with item. So basically, a lot more folks are going to be itemizing who are high income wage earners or just high income earners in general because their state income taxes plus their real estate taxes. They're going to be able to deduct that and then also take advantage of whatever mortgage interest travel deductions they've got there too.
So talk a little bit about the phase out there because when I first heard this, I got really excited. I was like, wait, no way. So because of the way my business is, it's me and a partner, we're an S corp, but I pay everything to myself in wages based on my client revenue and profit. So I don't really get to use, have a ton of profits because then I have to distribute for taxes. And that's worse off for me than just keeping it to me, not really getting PTET. And I wasn't going to get QBID anyway. So I was like, okay, amazing. I'm going to be able to deduct, $40,000 of state and local taxes, but it doesn't seem that way. I'm 4 months in the year and I'll have already, I'll probably cross 50 to 60K of state and local taxes and not even a high tax state. So I was like, great, that's going to be amazing tax savings, but there's a phase out.
Yeah, there's a phase out. It's up to, so basically once you hit taxable income of $500,000, you basically get dropped back to you begin getting dropped back down to the $10,000 SALT cap. You can't go below that, but that's the most you'll be able to. So basically, it just drops you back down to that over time.
Okay, and then at what income level do you fully get to the 10?
That one I need to that one I was trying to find in the text, but I know that it was saying that it basically. Essentially, I think it's not a very fast phase out, or if there's even a phase out at all, actually.
Okay, yeah. So my guess is it's probably pretty quick because a lot of this is definitely when you get to be a really high earner. And I know that maybe my lens of viewing this is weird. Our average client makes over $900,000 a year with our top 50 making over $1.5 million. So I'm like, how does this help them? And for most of them, this bill is going to increase their taxes.
Right. Yep. Yeah, it will. Yeah, right. It will for sure. And other than bonus depreciation, right? Other than depreciation and whatnot, that's totally agree with you.
Or QBID if they are not an SSTB. But a lot of those really high profit businesses are typically SSTBs in my experience.
Totally. Yep. You're totally right there. And so on that note too, they're also not going to be able to utilize anyone that's an SST, so pass-through entity tax deduction. This is something that everyone I definitely expected was going to be totally ripped from the tax code. It was not going to be eligible for anyone to use, and I was wrong. They did. PTET? Yeah, I expected PTET, which is basically those so when we were at $10,000 cap, all the states started making these certain elections saying, hey, you can pay your you can pay your individual taxes based on your business profits at the entity level and deduct it up there. Help the states out because
they love that.
Yeah, they could inch the rate up a little bit, but you would get more savings on the federal side. And it wasn't really the intent of what happened in Tax Cuts and Jobs Act, but the IRS just kind of washed their hands and said, fine, you guys do whatever. And so I fully expected that to get totally just disallowed this in the new bill, which it partially happened, as it always does with it's things always only happen in a partial way. So QBI businesses are still able to use PTET. They're still able to deduct it. They're still able to use it. But SSTBs or even non-investment income type partnerships, so if you've got some investment income, non-business income type partnerships, you're not going to be able to utilize PTET going forward. It's actually becomes separately stated, and then basically you're no longer allowed to utilize it, essentially.
So basically, PTET will be still exists for everybody that is not an SSTB. And then for an SSTB at any income level, you can't do PTET.
Correct.
Well, there's already been fights for people claiming that they're QBID eligible because there's really isn't a lot of stances, right? It's kind of like, do you want to take this stance? And we have this debate all the time with our client CPAs around are you a marketing agency or are you a marketing consultant, right? Marketing agency, you're good. Right. Marketing consultant, you're not good. Are you giving advice or are you execution? There's so much that goes into the conversation and wanting to take that stance that this is going to be even bigger now. I really have clients who save over $100,000 a year on tax from PTET just by itself.
Yeah.
And so this will be a really, really interesting one of even businesses might even look at how do you tweak it. I'm specifically thinking marketing agencies wide, right? If you're really just doing paid ads or you're really just doing influencer marketing, but you're not the advice side, you're going to be how do I really push into that lane? Because that's a ton of tax savings by having those tools.
You're totally right. Yeah. That's I believe they issued some a little bit of guidance somewhat on that, talking about hey, cooks, right? People are oh, is a cook an SSTB or not? And the IRS said no, a chef or a cook is not an SSTB, right? Despite the fact, Gordon Ramsay's a big name.
I was going to say, what if their restaurant is named after them? Isn't that the exact definition of an SSTB?
Right. So they kind of did narrow the definition a little bit when they issued out the regulation. But yeah, like you mentioned, so a chef or cook is not going to be considered an SSTB per se, even though Gordon Ramsay's name is on the building and all that stuff. But yeah, so it's like you said, there's a lot of nuance that goes into it, and it's not an easy it's probably one of the more gray areas of the tax code.
Super gray. Okay. What else we got?
Yeah. So definitely. So I was talking about PTET, SALT. So I will say the Senate has already talked about yanking the SALT cap. That's something that they've already had discussions on, saying, oh yeah, we might totally get rid of the SALT cap and basically what the Senate put in there, they might just try and yank out. We'll see if that gets passed when it comes back to the Senate, because what's interesting is that the power dynamic you have between the House and the Senate right now is because normally the Senate is the stronger legislative body. They have a little bit more sway in Capitol Hill. And so they can kind of tell the House, you guys are going to do what we want to. But the House is such a razor thin majority at the moment with the GOP that they actually might have a little bit more pull than the Senate does. It'll be interesting to see how that plays out over the next couple of months, because that'll definitely be something that's going to come out is seeing what happens there, because the Senate will definitely try to tell the House, you just got to take this, and they might say, no, we can't and we won't. So we'll see what happens there with SALT. Another one that happened, so we'll talk about the things that went permanent, right? With this bill that are now permanent, no longer sunsetting. Expansion of tax rates, those are now permanent.
Which that's helpful, right? Because the top marginal bracket would have been, 2.6% higher. So I guess if you think about it, some of these other things you might save a little bit as those high earners, but I guess it just depends.
What's so interesting about it is that it's because it's locking in rates that are already in existence. So no one feels that as a tax hike, right?
Yeah.
Had the rate gone up for a year, everyone from the lower to upper high earning class would have felt that tax increase, because all the rates basically are dropped down. But now no one feels that. It's just basically making sure what's already in place stays in place, and no one feels that pain.
Okay. That makes sense to me.
And then extension of the tax rate, so that's permanent now. This doubling of the standard deduction, that's also permanent now. And there's also a $2,000 increase that lasts for 4 years. That's another item that went to.
Is that supposed to be for this year or next?
That is for 2025. So that's for 2025. Yeah. So
it'd be 32 versus 30.
25 through 28. It's a 4-year provision. So a lot of these provisions are going to wind up being for 4 years, basically. I don't know if you noticed, but that also is when a certain president's term ends, and so someone gets to start campaigning on stuff.
Yep. So then another one with the extensions too is the higher estate tax exemption, which I think is important, right? Everybody's been talking about for the last 4+ years. Hey, you got to start planning for the sunset. The estate tax exemption is going to go from the 14-ish million all the way down back to 7. If you're a high net worth person, gift assets now. My stance always was, well, we can plan, but let's wait and see. And then everybody's like, well, hey, no attorneys are going to be available. It's like, okay, well, set up the trust structures that you want, right? They're kind of, you could deposit $20 into them, get those shell accounts set up. But with the exemption going to 30 million, right? It doesn't really impact people. I have a lot of clients that are 20, 30, 40, 100 million. And my stance on this still is if you're young and you're not above 100 million, I'm probably not doing a whole lot besides maybe like part of a business that's going to grow a ton. I'm not giving up that liquidity. Who knows? They've talked about getting rid of this entirely. Like there's going to be 50 exemption changes over the next 50 plus years. You probably don't want to be giving up all these assets out of your name just simply avoiding estate taxes. Estate tax is definitely one I see people really get worried about with just way too many changes coming and with how much liquidity you give up. And, most of it's irreversible. Unless you're like, I am going to be hundreds of millions of dollars over, I still lean on like, probably don't use them too much yet.
Yeah, I totally agree with you, Thomas. And it's something else that, like, someone asked me, others like, wait, so if it's permanent, does that mean it can be changed again? And the answer is yes. I mean, if Congress, like, sure, it's permanent, it'll be permanent in this bill, but that doesn't mean that a different Congress doesn't come down and say, actually, we're going to cut it back in half, or we're going to triple it, or just totally get rid of the estate tax at the end of it. Like, there's so much that can happen. So I totally agree with you. Is that like there's no reason to rush for those types of things.
Great point. Great point. Okay. I know another one is this kind of no tax on tips. And I think this has been like the talk of Twitter, right? Everybody's like, oh, I'm going to start taking my, income in tips. But I think the key part here is it says that the deductions equal to the amount of tips received for those making less than 80K, right? So if you're making above 80K, this doesn't really impact you. You can't be an SSTB. You can't be an industry that wasn't predominantly paid in tips before. So really, this doesn't change anything for almost anybody. And the vast majority of people paid in tips, obviously if you're a restaurant and it's on the bill, you're going to pay taxes on it. But all the cash tips, people were hiding before. Nobody was like, oh, I got $327 of tips this week. Let me make sure I log that for my taxes.
Right. Yeah. That's like the funny thing about it all is that like, it's like, yeah, no one's reporting those cash tips, right? Like not a single person's doing that. Now, like if you're getting it and it shows up on your W-2 because there's a specific like outline for it, great. You're not going to get taxed on that amount. If you're a bartender, a waitress, anyone like that, this is a massive boon for you, or a hair salon because that actually extended towards the beauty industry is what they said. And so they're actually able to have be eligible for no tax on tips too.
As long as you don't make over 80, which I would guess
80, and then 160 if you're married filing joint.
Oh, okay. So that made that fits because I'm like a good girl at a hair salon definitely is making more than 80K.
Totally.
Okay, cool. What else we got?
Yeah. So one funny thing about the no tax on tips was that the Senate actually already kind of approved this because they passed their own bill 100-0, which you never see bipartisan legislation anymore. So that was actually what spurred all the conversation on Twitter and X. And it's like, well, actually, they can't be tax law because all tax bills have to start in the House anyways. So that was super interesting. I thought there was a chance that maybe they'd try and take no tax on tips out before when the House is trying to pass it, maybe to gain a little bit of extra revenue because of the way it's being processed, but they didn't wind up doing that, but oh well. So no tax on overtime was the next campaign promise that Trump had. And so it's talking about what's qualified overtime. It's essentially going to be, again, the same threshold. If you're a married filing joint and you make $160,000 or less, you can qualify for this. And so if you work your standard 40 hours and then you work another 40 hours that week, so you're at 80 hours and you get paid time and a half for that extra 40, that half time that you got paid, that will not be taxable. So that will actually, so what's interesting is unfortunately the way it's written right now, it's a cliff. So if you go above that $160,000, you're no longer eligible for this. And it's like I personally do not like cliffs for tax policy. And the reason that is because it creates an unfair tax burden when you go over a threshold versus when you get phased out in other ways. So someone who makes $175,000 and gets a lot of overtime is actually going to be punished versus someone who's making under $160,000. Like that person under it will actually bring in more cash than the person who makes $175,000.
I always say you should never say no to more income because of higher taxes because it's really just marginal. And now I might not be able to say that in this situation because actually you could make more and have less take home pay simply because of being phased out.
Right. It's very small circumstances, right? That's probably not going to happen, but like it's still like it's not an amazing policy at the moment. It's also lasts for
Interesting.
4 years too.
I wonder, like, I have employees that make under 160. I'm probably better off changing their bonus structure to be overtime and being like, hey, I know you actually do work overtime. You worked on these weekends. I'm going to log this for you. And your $20,000 bonus is going to be structured as overtime throughout the year that you worked. And I'm guessing there would still be on both of our sides FICA taxes.
Yeah, FICA
And then
taxes
just
still
no
apply.
income
Yeah, it's
tax.
just federal income tax. Yeah,
But still, if you had a 20K bonus, that's, $4,400 more you would take home.
100%. Yeah, that's still a win.
It's really interesting. I mean, and as a business owner, you really do want your employees to be able to take home the most. If you can get them to take home more money by paying them the same amount, effectively you paid them more. So that's a really interesting one because the vast majority of employees at your company are going to be under 160K.
Right. Oh man, I think so. Real fast, child tax credit got a boost too. So it went from 2000 staying, that's permanent, no sunset, and it's going up to 2,500 as well. So 1099K limits. Those actually. So I know we had a $600 limit for Venmo, PayPal, etc. People have definitely been talking about. It's been in the news for a little bit. That's gotten yanked, so now it's gone back to $20,000. So now you're not going to get a 1099K from Venmo for doing rental payments back and forth with your roommate any longer.
Okay. What about this gross receipts test for small manufacturers to 80 million? So like small businesses usually have to move to cash basis and once they're averaging 25 million in revenue, now that's up to 80. So that means they can just stay on accrual.
So what that means? So this is a big boon for small business manufacturers. Which $80 million, are you small business? Is a good question, but regardless, essentially by raising the cap so high for them, there's a lot of flexibility with deductions, right? So generally, if you are over $25 million in gross receipts, you're very limited on your interest expensing, or you have to switch over you're forced to switch to accrual accounting, right? And so now anyone who's making, if you're a $60 million gross receipts manufacturing business, you actually don't have to switch to accrual. You can stay in cash. And so that can be more beneficial for me from a tax perspective, because you earn income as it's received, basically hits the bank account, versus and then make deductions as they're paid, right? So that's a little bit more advantageous for you versus, hey, when you have accrual, basically you have to look at how, like, when's the services performed, what, like, did you actually, like, now, like, looking forward in the future, when can you might be pulling an income that you necessarily haven't gotten in the account yet. So it's very beneficial for those folks. And then an additional item is the qualified production property. That's another thing. This bill is very helpful for manufacturers because now it's dropped in essentially the opportunity to expense, if you have a factory or build a factory after 2020, like, this is what's really important, and for bonus too, is if you place in service and acquire after January 20th, 2025, you will actually be able to be eligible for this. And what this allows is the entire expensing of a factory, essentially. So you'll have a mini cost seg on your office, parking lot, etc., just like you normally would. And so you have to do cost segs, pull out the 5 and 7 year property there. But then what would be the bulk of the factory or warehouse, which is the 39-year property, but that's normally going to be very slow depreciation over time. Now you actually get to depreciate and expense the entire amount, just like bonus depreciation.
Crazy.
It's nuts. So you could have a $5 million factory or warehouse, as long as the majority of it is for working on building and manufacturing and working in, like, basically a factory, then you'll actually get to expense almost the entire amount of the purchase, which is crazy. It's very, 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 very favorable for manufacturers, as the current administration really wants to boost manufacturing in the United States.
Saw that with the tariffs and that being the incentive too. So, okay, cool. I mean, the only other one was like those Trump like baby accounts where he's going to put like $1,000 in, and then it's like a federal 529, right? So can you put in 5,000 and it's a federal deduction, and it's like a 529?
Yeah, it's essentially it's a really strange. It's like, it was a MAGA account, now it's 520. Now it's a Trump account. Yeah, so the first year you put into it, you can put up $5,000 a year. The first year you basically get a credit back. This is how that works. You're going to get a credit back in your tax return by contributing to it. Yeah, and so you'll get the credit back, and then essentially you just leave it in there for your kids. And then once they turn 18, they can start drawing on it to pay for college, to pay off small business loans. I thought that was interesting. And so they can actually use it. So like you mentioned, it's kind of like little bit of a universal 529 plan, but there's like still some other rules attached to it. It's a
Can you
little
put 5 in every year as a deduction though?
no, unfortunately, you don't get a deduction for putting it in every
So
year.
after it's year one, so then nobody's ever going to contribute again, really, or because like, what's the benefit? I guess so. No deduction, but you could use it tax free on college or business or something like that.
Yeah, essentially, yeah. So it's kind of confusing. But I believe yes. I
So we
believe
probably
it's
just need
not
more
tax.
guidelines. It's just kind of thrown in there because like if you're not going
Yeah,
to get a
it's a little
deduction,
strange. That's one that I wouldn't be shocked if it goes away, just because it's like I personally am not sure what the benefit here is. Like it's like we should have probably just expanded 529s or HSAs or just
529
had
should just be
actual
federal. I just don't know why it's a state deduction, right? Give it a federal
right.
deduction up to a small amount where it's still not that big. Incentivize people, let it be for college or starting a business, or give it a few more
Yeah.
options.
And then there were actually changes to HSAs too. So one of the big ones that I saw is that if you're married filing joint and you make $150,000 or less, you can actually double your HSA
Oh
contributions.
wow. Just funny because like what person at that level is putting 17,000 into an HSA? Like most of them aren't even maxing out, but they're using it. And I mean, your out of pocket max, I mean, you need a large out of pocket max, which would incentivize them to actually invest it. And it's like, do they actually invest it? I mean, at high income levels, it makes sense. But I mean, at that income level, you still get the full FICA tax deduction, 22 or 24%. So, I mean, it is really impactful.
Right. Yeah. It starts at 150 and then slowly phases out to 200. It like basically phases you back down to like the actual $8,000.
They should have just made it that HSA limit is whatever your year's out of pocket max is the max. Like that seems like it makes way more sense. And I don't know why you can't have it at any plan. Like why isn't it FSA even matter? Just give everybody the ability to have an HSA. The annual contribution limit is your family out of pocket max. Use it how you want.
So to that point, actually, they did say once upon a time, I think back in like 2012, you could roll leftover FSA funds into an HSA. That currently is in the bill right now too.
Oh,
So if you have a
interesting.
leftover FSA, you can roll that into an HSA, which I thought was interesting.
It's annoying to mechanically have to do, but I mean,
Yes.
if it's better to have the lower deductible plan for your family, 5,000 rolled to an HSA every year at Fidelity, get it invested. That means every one of my clients would use an HSA yearly then from that because we don't have anybody who would spend HSA dollars.
Right.
Wow, that'd be cool. That's a good one. I didn't hear that.
Yeah, we'll see what stays.
Okay, cool, man. Any last points that you think we should hit on? I mean, as I look through kind of these summaries, that's probably all the main ones that I think apply.
Yeah, those are the main ones. There are some other smaller ones like auto loan interest, etc. Right? That's some of that stuff. There's definitely, but like, look, there's a lot in this. And again, this is not a finalized bill by any stretch of imagination. There's a high chance that Thomas and I will be back here.
I was just going to say that once it gets passed, let's do this again with here's what it is. And now let's also talk about planning again around it.
100%. Yeah, I totally agree with you. Yeah, because like you said, who knows when that's going to wind up happening, and it could definitely change from here and then. Like we didn't talk about QOZs because it's not what we're talking about because the Senate is definitely going to change a lot there.
That's true. That's the one that we haven't talked about. And obviously, you're in Texas. You know Barrett. Barrett's been talking about these qualified opportunity zones forever, and I'm not like super in love with them. I think they're a good tool. I think the average person you talk to who's invested in a qualified opportunity zone, their returns have been pretty terrible. And so this is one that's like, yes, you defer your capital gain, but right, it's just a deferral. You're going to be paying it later. For certain people, if the tax bill would have sunset, they maybe would have deferred it to a potentially higher tax rate. I guess I don't remember if capital gains would have changed, but there's that. And then you get the 10 years of tax-free growth. But if the tax-free growth didn't beat what it would be a taxable investment, like it's not necessarily better. I think it's a good idea to incentivize building in communities that need it. But I, as an investment thesis and case, I definitely don't think in general, qualified opportunity zones are higher expected returns or even close to other markets.
Yeah, there's definitely, it's so dependent, right? There's definitely some like really bad ones out there, and there's some that are okay, right? And so it's all about freaking like you always say, Thomas. It's like figuring out what your goals are and your plans are, and how it's going to ultimately work for the client. And if it works, great. Like to defer the capital gain and to also invest something you probably would invest it in anyways. Cool. It's a perfect marriage.
Yeah. Okay. Cool, man. Well, really appreciate you coming on and joining us. What's best places for people to follow and engage with you?
Yeah. So if you just hit me up on Twitter/X or LinkedIn. I actually have a weekly newsletter that goes out that will we talk about it's on Tuesdays and I'll either give you an update what's going on with the tax bill, or we'll be discussing a tax strategy that I ran into from the prior week or something like that, something that I feel like is relevant to all of you.
Love
So
it.
that's another way. We also have our bill tracker 2025. So if you go to Hall CPA, if you just Google Hall CPA bill 2025 tracker, then you'll find it right there, and you can get that any updates we push out from there in your inbox too.
Love it. Love it. All right, everybody. Really appreciate you listening. Please don't forget to rate this 5 stars. We're getting up there. I think we have like 65 now. And if you really like me having a guest, let me know. This is going to be something I'm going to be doing a lot more. I love the conversations and learning from them. And hopefully you do as well. So we'll see you guys back next week.